$815 billion in assets under management over at Ameriprise. What was the atmosphere like on the trading floors in your offices yesterday?
Well, obviously a heightened sense of intensity, if you will. We all knew looking at Asian markets on Sunday night on the East Coast that they were gapping down. And then as we woke up, we saw what had happened in Europe, the same kind of dramatic decline. So you knew it was headed our way. So the first thing you notice in trading rooms on a day like that is a lot more people in the trading room, just wanting to be there watching the screens, see what happens. And then we saw the futures point to a huge down opening. So it was pretty tense, I have to say. And the feeling that I got emotionally watching it was reminiscent to me of 1987, watching the stock market crash, and a sense of simultaneous sense of awe at what was happening, the speed at which it was happening, and yet at the same time, a little bit of sense of helplessness that, as you just pointed out, a lot of things on sale, but the ability to capture those in an actual trade, very limited. And so, to some extent, it's a little bit of a helpless feeling when it happens.
Well, we got a little bit of breaking news right now. We're watching the numbers very closely. The Dow Jones Industrials still up, but just dipped below up 200. So now we've lost even more here. We're up about 189 points at the moment. Now it's 85. Suddenly we are coming down. This is why we blew out all the commercial breaks. We want to tell our viewers we will not be taking commercial breaks, because in each and every second of the trading session, there are headlines whirling around the world, and any one of many hotspots, whether it's China, Iran, the U.S., Russia, could actually affect this market. We're just going to make sure that we very, very steadfastly keep you posted each step of the way. David, what were you and what are you advising clients to do today?
Well, the first thing is that we've hosted a number of different opportunities to speak with our clients through conference calls and answering their direct questions and so forth. And what we're explaining to them is, first of all, we are long overdue for a correction. The normal interim is 514 calendar days. This one had gone 1,400 calendar days. So we were, to a certain extent, overdue. Number two, the average correction over time witnesses a decline in the S&P by roughly 12%. So we've kind of bumped up against that prior to today's opening. So we feel as though the U.S. economy actually looks okay. We think that it's probably growing at around a 3% rate. Clearly, China has a big impact on the pace of global growth, but we're advising them to stay the course. You know, most of our clients are long-term investors. Many of whom have financial plans. They're well diversified. And so we're not seeing anything necessarily that they have to do dramatically. But we want to keep them informed. We want to be able to and available to answer their questions.
The answer that you give to this next question, I think, will be of great interest to our viewers. You, as somebody who has that much money in assets under management, what is the bigger worry for you? China and its floundering economy, or the day the Federal Reserve finally tightens interest rates, David?
Oh, for me, it's clearly China. To me, the Fed has become a secondary issue. It's important, but I don't think anyone really thinks that a 0.25% point is going to make a big difference one way or the other. But the issue with China is this. I know you've been talking about its impact on the global economy.
Of course.
And trade is a very small part of our economy. But the stock market is different from the economy. The S&P derives a third of its revenues from overseas. So the market is much more leveraged to trade than the economy is. So we've got kind of a bifurcated issue here. One, I think the U.S. economy is fine. The consumer's in good shape. But the market is still at the mercy of what happens, to a large extent, overseas. And China will dictate that, at least in the near term.
Do any sectors fascinate you and your team?
Well, we like in the U.S. The domestically focused sectors of, for example, consumer discretionary. As I mentioned, the consumer balance sheets are in good shape, so you're starting to see good strength now in housing. Automobile sales holding up. High-end retail looks pretty good to us. So that's one area. I think also financials in the U.S., they've cleaned up a lot of their regulatory issues, not so much impacted by what happens overseas or the strong dollar. And thirdly, there are pockets in the technology space that we like because I think there needs to be some ongoing spending there by the business sector. But at the other end of the spectrum, I think commodities, materials remain under pressure. I think oil remains under pressure. and industrials until we see better evidence of a reacceleration of global growth.
David, I'm not going to blame you, but we're suddenly up just 153 points. This rally did not hold. The rally is not appearing to hold.
This is very similar to what happened yesterday. We saw a nice recovery into the middle of the day. But as we were reminding ourselves, a lot of that is algorithm-driven, high-frequency trading, so you have to be very careful of that. And what is most important, as you said at the top of the show, what happens in the last half hour will really tell the story.